Okay, great. Thank you, Courtney. It's my pleasure to give you a little profile on Michelle. Michelle Pierre is a highly experienced and dedicated mortgage broker serving the community of Brantford, Ontario, and our surrounding areas. With over 10 years of experience in the financial services sector, combining both banking and independent brokering, Michelle has developed a deep understanding of the local housing market and the complex world of lending. Michelle distinguishes himself by leveraging his strong background in economics to help his clients. He provides a holistic perspective that goes beyond simple rate quoting, analyzing market trends and economic factors to position his clients for long-term financial success. To keep his clients informed, Michelle actively provides market and economic updates through his social media channels. Beyond professional life, Michelle is an active and devoted member of the Brantford community. He's a proud member of the local Rotary Club and actively volunteers for various community initiatives, embodying a commitment to service and giving back.
Thank you so much, Darlene. That was a really great bio. Really appreciate the kindness. And once again, thank you everybody for having me. I really appreciate this. So this presentation is all about how do we have an opportunity to age in the home that we live in, and how we have financial security in retirement. Now, this presentation is going to be split up into almost two separate presentations in one. The beginning is going to be very statistical based. Now, the reason for that is we have to know all the current stats and all the future statistics of retirement and aging, so we can plan that all, so we can plan for that all ahead of time. The dynamics of retiring and aging has changed significantly over the past 20 years. And we're going to go over all that data and the impact it can have on your savings plans, on where you live. And the next part is going to be strategies about how we can stay in the home that we live in, live comfortably, absorb some of the additional costs that are going to be happening in the future without depleting our savings, without having financial stress. And there's going to be proactive strategies to happen before retirement. So there'll be a takeaway for that. And also reactive strategies during retirement, where we can start rebuilding any of the gaps in the plan that we didn't have before. And of course, the last slide will have my contact information and how you can get a hold of me there. So first off, the realities of aging in 2026 and beyond, and the financial implications of that. So, as many of you probably know, Canadians are aging and their lifespans are increasing. The average lifespan in Canada right now is 82 years, roughly. It's about 84 for women and about 80 for men. So that's projected to continue to increase, all right? Now, there's an implication for that. The longer that we live, the longer our savings for retirement has to stay and has to sustain us. So if you retired at 60, you could live till 80. That's 20 years. If you're living beyond 80 and you're retired at 65, you could be looking at 20 plus years of finances that you need to plan for. And we're going to get into some of the things that you have to plan for as well. We live in a very dynamic world where lots of things are changing. And staying abreast with that information will help you in the future plan for those unexpected expenses that can be happening. Now, of course, longevity is a great thing, so we don't want to say anything negative about that, but we still have to plan for those additional years. So, projections. One of the major projections that's happened is, of course, lifespans will increase. It looks like it's going to be about a 1 to 2 year increase on the average lifespan over the next 10 years. Now, remember, that's average, right? So individuals are going to be living longer than that. Some will live shorter than that. So you can't just plan for the average. You always got to shoot for the moon when it comes to your retirement planning strategies. So if you think about a 2 year increase, that brings women up to 86 years and men up to 82 years. So we're getting closer and closer to that average age becoming closer to 90. Now, back when I worked in the bank over 10 years ago, we were instructed to do financial plans up to 90 years old because we saw many of our seniors outliving their financial savings there. And of course, which we're going to see in future slides, there are specific financial needs that seniors have that you have to factor into those plans, and they can take a chunk out of it if not properly prepared for. So, yes, we have to be very mindful of increased age and lifespan lengths when it comes to our planning and our lifestyle choices as well. Now, this is a major thing that's been happening lately. Uh, Inflation, consumer price inflation. It is a big impact on everybody, but on seniors, it has a very, very, very high impact. Um, the major benefit, the major non-essential goods, as in the things you need to live, have gone up some of the most over the past 10 years. We're going to go over some of this data. So over the past 10 years, the pressure for home or home prices or cost of homes in general have gone up 45 to 50% over the past 10 years. Now that includes things like utilities, rent, heat, hydro, repairs on the home. You know, it's expensive to get individuals to come in and do jobs in your home. And another thing that many of you have probably learned, if it's a small job, a lot of the bigger contractors don't want to do it, or they'll price you a certain amount because it has to be worth their time. Because since it is expensive to do renovations, they would rather do a bigger job than a smaller one. So there's a lot of extra costs there for staying in your home. We'll get into renovations a little later because there are specific needs for seniors that we have to address with that. Transportation costs, 28 to 32%. So that's your transit, your insurance, new cars, repairs on your cars, fuel, so gas prices. Have to be mindful of that. When you're on a structured budget and you have places you have to go to, these additional costs are now taken away from that fixed income. So it is creating shortfalls for individuals. And these are necessities that they have to go to, right? You don't want to just stay in your house, right? And if you are independent, you do have a vehicle, those repairs and those insurances keep going up and up. Insurances are projected to continue to increase on vehicles as more vehicles unfortunately get stolen and accidents do occur in Ontario. They spread that over everybody, right? So that's how the insurance companies do their pricing. So those costs are going to continue to go up. And of course, the one we all know, the grocery store, 38 to 42% increase in staple foods over the past 10 years. That's not going down anytime soon. So you can see here a lot of these fixed costs in your lives have been going up and up and up. If we dovetail that back with longer lifespans, so you have budget constraints with cost of living, and also you have to have that plan that you have last longer. So you're getting hit on two sides here uh, in this world right now when it comes to cost and life expectancy increasing. You're getting a bit of a squeeze on your savings both ways there. And later on in the presentation, we're going to go over some strategies that you can employ now or employ later on to bridge the gap there for those expenses coming up. You know, sometimes depleting your savings is not going to be the best option, as we see with the longer life expectancies. Now, with seniors, as I mentioned a few times, and retirees, it hits you a little bit harder for a couple of other reasons. And one of the reasons why shelter inflation has a hidden cost for seniors is disability and accessibility and mobility issues, right? As we age, you know, I'm getting there too, we start to need mobility aids around the home. And a lot of those mobility aids aren't cheap. And when you look at the statistics and the numbers of the amount of seniors that require some level of mobility aids, it scales as you age. So roughly 25% between the ages of 65 and 79 require some mobility support in the home. 25% of all seniors have some defined mobility issue, whether it's going up or downstairs or up and out of a bathtub, for example, right? Now, these mobility aids are important to remember because these are additional costs that seniors have to cover, right? If you need to do a full-blown renovation on your home to put in an accessible bathroom or to put in an accessible kitchen or to put in a ramp or a chairlift, these are all costs that seniors have that the younger generation, most of them, don't incur, right? And when you're planning when you're younger, you're not thinking about this kind of stuff. So you're not having an emergency plan for what happens if I want to stay in my property but I can't use the stairs anymore? Or what happens if I'm staying in my property and that bathroom is no longer accessible? I need a different shower, and I also need a vanity where I can get a wheelchair accessible vanity. that goes back with renovation costs going up, right? So you can see how all this ties together where we're living longer, the expenses are going up, and the needs of some of those expenses are going up as well. So that's important to remember. Some of the more common options are, of course, the bathroom aids like bars and benches, 38% use that. Walk-in tubs and showers, ramps to get in and out of the home, and also chair lifts. These are all things that seniors who want to age in place and age in the home that they love um, might need. And the statistics are showing that it's getting more leaning towards that. And I could see these numbers going up and up and up as our population's lifespan continues to go. Um, and of course, if we continue on with inflation and shelter and food costs and the impact on seniors, of course, food costs are a fixed goods. You have to have food, right? I do a lot of volunteering with the Blessing Center, which provides hot meals for individuals in need. And we do have many seniors who are coming now just for one extra meal a week where they don't have to deplete some of their additional savings because of the additional costs that are happening all over the place for them. Food insecurity among seniors, it's 10 to 12%. So roughly 1 in 10 seniors have some level of either moderate, severe, or marginal food insecurity in our communities, right? There are seniors skipping meals because of how expensive it is to stay where they're living and the costs of Canada in general right now. And of course, these additional costs on shelter, on food, on transportation, the basics, takes away from the other options that you would like to do, vacations, uh, grandkids, presents, and whatnot there. So there's still financial pressure on seniors to do that other thing and be community members as well. But of course, with the financial constraints of the fixed cost of living now, it is getting tougher and tougher to do that. So that is dovetails to longer life expectancies as we've been talking. Of course, there's the major strength to longer life expectancies. You can have a more active retirement, lots of traveling, you can take up art projects, you can do all the stuff that you wanted to do when you were working, and have maintain a higher quality of life. Of course, I don't want to use the term weakness, but the issue, of course, is we have to budget and plan for that longer lifespan too. So we want to maintain our lifestyle and maintain our mobility and be able to stay where we are without suffering additional costs or stressing out over money. Now, an opportunity here, of course, is home equity as a way of doing that, which we'll go over later on in the presentation. And there's also additional threats with who knows what inflation is going to be like, who knows what costs of repairing homes or new cars and all these things are going to be as well in the future. So as we move out timelines, if you do any type of financial planning or any type of risk management, the longer your timeline gets, the riskier things get because more things can happen during that time that can severely affect what your plan is. A 5-year plan is great. A 10-year plan is really tough because it's easy to project 1 or 2 years what's going to happen, but once you get to 5, it gets a little bit, there's more question marks, right? And once you get to 10 or beyond, um, then we start thinking about, well, anything could be happening. So that all dovetails back to the longer life expectancies that we're going to have. So having that robust strategy up front is going to save a lot of heartache. Another major thing that's happening that hasn't happened in the past is more and more retirees are retiring with a mortgage. It's roughly almost 30% of Canadians. Now, why is this going on? Number one, cost of housing is a lot more expensive now than it used to be. Number two, first-time home buyers, the average age of first-time home buyer right now is 40 years old. So more individuals are buying their home later on in life when you think about a mortgage of 25 to 30 years, right? If you're buying at 40, well, now you're going to be at 65 if you've never touched that mortgage, if you just paid it all the way to completion without refinancing, pulling equity out, or doing anything, and you stayed in that place, right? So that's just based off of amortization schedules. Also, cost of living is much higher now. People have in Canada, this was a thing, and many of you probably avoided this, but I called it the third income. So, as a mortgage broker, we called it the third income, where people basically used the home equity as a third income for themselves over time. They they would rack up a credit card debt, they buy a new car, their mortgage come up for renewal, they would refinance. The properties were always going up in value, so they would pull the third income out, which was a refinance, to pay everything else off, put it in a structured mortgage, and start paying it down again. The problem with that strategy is if you do that continuously, you're never actually paying down your mortgage, and you end up like the 30% of Canadians now going into retirement with a mortgage, and they have to make a decision about how they're going to manage that mortgage. Now, not all these mortgages are large, of course, but it is important to understand how we're getting into that. And a lot of that is cost of living and just certain delays that are happening now, like people getting into housing a lot later than they used to. And of course, carrying a mortgage into retirement, if you're on a fixed income, that can cause some shortfalls in your monthly budgets, um, and other anxiety as well. If you do have a lot of debts, like credit card debt, um, and line of credit debt, and of course a mortgage, that adds additional stress. It takes away from your mental health, and it could take away from your lifestyle as well. And if you are someone going through other types of health issues, having financial strain on top of that is definitely not a great situation to be in. And it's tougher and tougher and tougher when you're in financial hardship, because the longer you wait for a solution, though I'll say the more nastier the solutions get, the more expensive they can be. So planning ahead is always something you want to do to avoid getting into a situation where you are having to do something you don't want to do, like take a loan on that's high interest or sell the home just because you can't stay there anymore. So that was all the statistical data about where we at in Canada so far when it comes to aging. Now we're going to talk about strategies to stay in the home that you love and how to make your lifestyle more comfortable, and what that's going to look like moving forward. So, quick recap, of course, we talked about seniors living longer. We talked about cost of living increases, and planning to outlive our savings. That's going to be something we always want to think about. We don't want to wake up one day and have a huge bill coming in, and then all of a sudden we have to make some decisions about, are we going to pay that bill? Are we going to sell our house? What are we going to do? Um, so when it comes to strategies, especially when you're using any level of home equity with strategies here for retirement planning, there are two major strategies. Well, there's three if you include downsizing. Um, the first strategy is the home equity line of credit strategy, which you would be employing that before you retire. So this would be for individuals that you know who are about to retire. And we're going to go over that strategy. It's a great proactive strategy to set yourself up for retirement without having to worry. And then, of course, there's more of our reactive strategies, which are the reverse mortgage options. Reverse mortgage options have a bad reputation, of course. Uh, However, the reason why reverse mortgages had a bad reputation, especially in Canada, is there was only one player at the time in Canada that did reverse mortgages. There was only one. Now there's five. And when you have five competitors, now it starts to lean more towards shopping, which means it leans towards the client benefiting over the lenders many times there. So that is a brand new thing that is going on in lending. There used to only be one, now there is five. And there's more than likely more lenders that are going to jump into the reverse mortgage space to create more competition to lower the costs of reverse mortgages. That's just the nature of business. There are more Canadian seniors than there are, just the way that our population dynamics are. So it's not a fully altruistic thing, but they are looking at the opportunities in reverse mortgages to create cheaper and cheaper options there. And we're going to go over the two types of ways that reverse mortgages can help. And of course, a quick little note on downsizing. Downsizing is the other option as well, which is a great option. Now, one of the things about downsizing that my own parents have learned is you have a home and let's say it's 750,000 and you want to buy a bungalow and it needs renovations, you're almost trading dollar for dollar on home prices now when it comes to, especially where you want to live in town, right? Homes aren't really that cheap anymore. Condos are a little bit of a better deal for that. But if you are looking at a home where you can have the grandkids and family over and all of that, the downsizing options are a little bit different now than it was many years past, where you had a massive cash out from your downsizing. Now it's borderline dollar for dollar, and if you need renovations, it's going to pretty much be dollar for dollar. So what is the home equity line of credit strategy? Well, first we'll go over what a home equity line of credit is. A home equity line of credit is a line of credit that is secured to your home. Because it's secured to your home, the interest rate's actually lower. It is typically prime plus one to prime plus a half. Depending on the size of the line of credit, you could actually get even lower than that. Now, the reason why this is a proactive strategy and not a reactive strategy is the days of walking into your bank and shaking the branch manager's hand and getting a mortgage or a line of credit, that's all gone now. You have to income qualify for this product specifically. So if you wanted to get a home equity line of credit, you still have to go through the normal credit application. So credit checks, income documentation, etc., home evaluation. Now, why this is a strategy for before retirement is right before you retire, typically your income is the highest and your debt load tends to be the lowest. So after you pay off your mortgage, getting a home equity line of credit right away on your home gets you that emergency plan in place right away before you retire and your income drops, making it more difficult for you to qualify. Doesn't mean you won't qualify. There are other options for qualifying with home equity lines of credits like high net worth. Um, but if you do want to get the full benefit of the maximum size of the line of credit you can get on your property, having income is the way to go. And that typically is the highest rate before retirement. That's why this strategy is proactive. Now, home equity lines of credits are great because there is no cost to having one. So there's no monthly fees or no annual fees. If it sits there unused, then there's no interest. The interest is prime plus an adjustment factor, typically one or half a percent. Um, and you only pay what you use and it revolves, as in if you take $500 off of it, and pay that 500, then your credit limit stays the same. You get to reuse that amount later on. Just interest only payments are the minimum. So this is a strategy going into retirement that gives you that emergency planning for those renovations if you need it, or for any of those other expenses that can come up without having to deplete additional savings that you have there. Um, Great strategy to implement while going into. And even in retirement, you may still qualify depending on the type of pensions you have coming in and the size of line of credit you're looking for, right? Sometimes just a 25 to $50,000 is more than enough to sustain those odd little events in your life there that can come up. Now, of course, the big elephant in the room is always reverse mortgages. Now, as I mentioned before, there's a lot more competition in the reverse mortgage space than there was before. So there's a lot more client-friendly experiences now where individuals are starting to see the rates drop. They're starting to see fees covered and whatnot there. Uh, Now, reverse mortgages, they come in basically two forms. There's the lump sum form where you take an amount out. So let's assume that you're in a situation where you were one of those retirees that had a mortgage, and it's not a big one, but you want to get rid of that monthly payment. You can do a reverse mortgage application to pay that out. Um, or you have renovations on the home you need done. So let's say you want to stay in your home, but you need a lift, you need a ramp, you need an accessible bathroom, but it's going to cost a lot of money. Instead of going through your savings plans and then hoping that that lasts you the rest of your lifespan, you can tap into that home equity and use that instead. That way, you're not affecting your current savings plans there. Now, reverse mortgages, of course, have no monthly payment, and the application process is different than home equity line of credit. It is based off of your age and the value of the home. That's it. The only other requirement for income wise is they want to make sure that you can maintain the property taxes and insurance on the property. Now, one of the other things about the reverse mortgage that people don't know is you can actually take, instead of a lump sum, you can actually take a monthly dividend every month out of it instead. So if you do have expenses like a condo fee, or you do want additional monthly supplements, like an additional $1,000 a month, we could actually set that up to be like that instead in perpetuity, just from their home equity. So that comes into supporting all of the additional costs of living increases that we're having now. Remember, the goal is to age comfortably and still maintain your lifestyle, right? It's going to get tougher and tougher as we move on to find suitable housing. And the only other solution is to create our own suitable housing with our own finances. And sometimes to do that, it's better off looking at lending options than it would be to deplete savings plans. As lifespans increase, we don't want to run out of our savings plans there. Now, another thing about any type of equity lending, whether it's a home equity line of credit or a reverse mortgage, whether it's the monthly income stream reverse mortgage or the lump sum, is this is tax free. So it will not affect your CCP or OAS or retirement at all there. So it provides tax-free cash to homeowners so they can stay in their home and make their home more accessible for themselves. Um, Now, the only downside, of course, is with a reverse mortgage, since there is no monthly payment, that interest you're being charged every year gets added to the balance of the mortgage. So the mortgage will grow over time. But that is the price to pay if you want to stay in your home and not have additional costs. The cost benefit analysis on it for a lot of seniors works out to be I get to stay in the place I love and I can still maintain that lifestyle that I want to have, opposed to cutting back or depleting my savings, right? The goal is we want to keep seniors active in the community. We want to keep them in their homes. We don't want people to get into a depression because of financial situations. So there are ways of taking advantage of home equity, especially with house prices being so high, to alleviate some of the financial pressures and strain there. And this just goes over what I just talked about, the different types of options. So you have the lump sum cash out. You can use that to debt payouts, or you can do that annuity, as in every month you can receive an income from a reverse mortgage there. So that is the conclusion of my presentation there. This is my contact information here. You can also go to my website if you want to book directly with me as well. I do have a Calendly link there. So that's valhallamortgages.ca. My direct number is 226-920-5235. I use my cell phone because it's easier to get to me directly than go through as a landline. And of course, Michelle@valhallamortgages.ca. Also, if you're on social media, you can find me at Valhalla_mortgages. And that's on Instagram, Facebook, LinkedIn. If you're on TikTok as well, it's there too. So that concludes the presentation. Thank you so much for giving me the floor.